In 2027, the United States will face the largest debt rollover event in its modern history, a moment where trillions in obligations return demanding payment at higher rates. For decades, America has survived by refinancing old debt with new debt, kicking the crisis further into the future. But 2027 is different. The wall is real, discharged to running out. Turquoise explores how years of near-zero interest rates created a financial system addicted to cheap money. A system that flourished when borrowing was free, but now trembles as borrowing becomes expensive. Can U.S. government bonds once represented safety? Now they represent strain. Corporations borrowed recklessly, believing low rates would last forever. Consumers followed, taking mortgages, credit lines, and loans without considering the cost at 7 or 8%. In 2027, all of these promises return simultaneously. Praying that was once manageable becomes a mountain too steep to climb. Investors begin to whisper about the debt wall, unsure whether the U.S. economy will slow down or slam into it. And as interest payments rise, a dangerous question emerges. What happens when an empire runs out of room to borrow? What happens when refinancing becomes impossible? What happens when the bill finally arrives? The U.S. government must roll over trillions in Treasury bonds, the very backbone of global finance. These bonds were issued when rates were near zero. Now, they mature in a world of high yields. Refinancing them means America pays far more just to stay in place. Interest payments exceed military spending. They exceed healthcare spending. They exceed every budget category besides Social Security. This isn't just a financial problem. It's a political disaster waiting to ignite. As borrowing costs explode, Congress faces a painful choice: raise taxes, cut spending, or borrow even more. The markets watch closely, aware that hesitation alone can trigger panic.
Foreign buyers, once the biggest holders of U.S. debt, are stepping aside. China reduces holdings. Japan stabilizes but does not expand. Blankets other, funds look elsewhere. With fewer buyers, yields must rise to attract new ones. And when yields rise, costs rise. And when costs rise, debt grows faster, a loop that spirals toward collapse. Freeze quietly burning beneath Washington. Corporate debt is the hidden danger behind the 2027 crisis. From tech companies to real estate giants, millions borrowed heavily during the era of free money. Low rates made risky bets look safe. Companies refinanced endlessly. They expanded aggressively. They hired employees, took on leases, bought back shares, all supported by cheap debt. Blackjack, but in 2027, the corporate repayment cycle peaks. Massive loans come due. Bond maturities pile up at the fastest pace in decades. Refinancing becomes a nightmare as interest rates triple or quadruple. Pensions once profitable at 2% borrowing costs becomes insolvent at 8%. Zombie corporations, kept alive only by cheap credit, begin to collapse. Layoffs rise. Stock markets wobble as balance sheets crack. Flooring executives scramble to cut costs, sell assets, or beg banks for extensions. But credit markets tighten. Forging become cautious. And corporate America realizes a harsh truth. When debt becomes expensive, growth disappears. America's households are stretched thinner than ever. Credit card debt has hit record highs. Mortgage rates are near multi-decade peaks. Auto loans last 7, even 8 years, and still, people can't afford cars. Prosecute in 2027, millions will face higher payments on everything from adjustable mortgages to variable rate loans. The dream of homeownership cracks under interest rates many thought impossible. Rent rises faster than wages. Groceries cost more each month. Medical bills grow heavier. Fastball, debt is no longer a tool, it is a trap. The middle class feels squeezed, suffocated, cornered. Savings shrink. Emergency funds vanish. Working 2 jobs becomes normal. This isn't a recession yet, but it feels like one. A country built on consumer spending watches its engines slow down, cough, and sputter. The question becomes, cling happens when millions can no longer borrow, spend, or keep up. Markets crash long before headlines acknowledge it. The bond market whispers before the stock market screams. In late 2026, a strange pattern emerges in U.S. Treasury auctions. Bid-to-cover ratios weaken. Primary dealers step back. Foreign buyers hesitate. Interest rates rise before the Federal Reserve acts. This is the first tremor, the one most people ignore. Liquidity dries up. Suddenly, treasuries, once the safest asset on Earth, move with violent swings. Traders call it unprecedented. Economists call it alarming. Overriding, a treasury auction nearly fails, the first sign the world may be unwilling to buy America's debt at current prices. A failed auction is more than an event. It is a global shockwave. Because if the US government cannot borrow cheaply, the entire system wobbles. And when the foundation shakes, everything above it begins to crumble. The moment arrives slowly, then all at once. Interest payments spiral. Markets panic. Borrowing freezes. Corporate defaults rise sharply. Consumer sentiment collapses. Banks tighten lending. The economic machine slows like an engine starved of fuel. The debt wall has been hit. Not with an explosion, but with a grinding, suffocating force. The US enters a recession deeper than policymakers expected. Millions lose jobs. Business shut down. Investors flee risk. Bond yields soar as panic spreads. The world watches the American economy struggle under its own weight, realizing that a system built on endless borrowing finally ran out of future to steal. This is not the end of the US economy, but the end of an era. Blatantly where debt had no consequences.
An era where time felt infinite. Now, the bill must be paid. After the crash comes the reckoning. The US must decide how to rebuild its financial system. Austerity becomes a political battlefield. Taxes rise. Spending cuts ignite protests. The Federal Reserve explores controversial tools: yield control, balance sheet expansion, financial resets. Corporate America restructures, downsizes, and automates. Consumers shift from spending to survival. The global economy enters an age of cautious credit, slow growth, and high debt service costs. But within the chaos lies transformation. New industries emerge. New financial systems develop. Schizophrene, never leaner economy may rise, but only after the consequences of decades of cheap money are fully absorbed. Fingered 7 debt wall is not merely a financial event. It is a rewriting of the economic future. A reminder that even the world's most powerful economy cannot borrow forever, and a warning to every generation that follows. When the US hits the debt wall, the world trembles with it. Every major currency reacts violently as confidence in the dollar weakens. Emerging markets face capital flight as investors pull money back to safety. Europe struggles under its own massive debt pile, fearing contagion from across the Atlantic. Asian markets tighten credit to protect themselves. Export nations suffer as demand collapses. Commodity countries see prices crash overnight. Supply chains slow to a crawl, creating shortages in unexpected places. Bankrupt in multiple countries freeze lending, unsure which institutions are exposed to US debt. The IMF issues emergency warnings. Financial ministers hold midnight meetings. Markets open with blood-red screens across 3 continents. Gold spikes. Cryptocurrencies surge with panic-driven speculation. Bond yields in vulnerable nations explode to levels not seen in decades. One thing becomes clear. A U.S. debt crisis is not a domestic event. It is a global earthquake. An earthquake with aftershocks that can last years. An earthquake capable of creating new winners and permanent losers. As the debt wall hits, a silent war erupts inside global credit markets. Banks begin hoarding cash, terrified of lending to the wrong borrower. Hedge funds short corporate bonds. Private credit firms smell opportunity and step in where banks retreat, charging higher rates than ever before. The Federal Reserve tries to calm markets with liquidity injections, but investors no longer trust cheap solutions. They want stability, not temporary relief. The credit markets become a battlefield, with fear and greed clashing every hour. Government officials deny the seriousness. Economists argue on live television. Ordinary people sense something is wrong, but cannot understand why everything suddenly feels more expensive. Corporations delay projects. Startups cancel product launches. Retail chains prepare for a collapse in consumer spending. This is the part of a crisis that few notice. The quiet tightening that suffocates an economy long before the headlines acknowledge it. The invisible chokehold of credit. The slow-motion contraction of opportunity. The part where survival becomes more important than growth. And only the strongest borrowers make it through. By now, the weakest companies are already collapsing. Blind's highly leveraged firms, once celebrated for rapid growth, now crumble under interest burdens they cannot escape. Worldview giants announce mass closures. Real estate developers default on projects mid-construction. Tech startups that relied on endless fundraising shut their doors overnight. Airlines restructure. Manufacturers downsize. Transportation companies file for bankruptcy protection. This wave of corporate destruction is not random. It is mathematical. When debt becomes too expensive, business models break.
When refinancing becomes impossible, survival ends. Analysts call it a corporate extinction event, the largest mass default cycle since the Great Depression. Investors who once chased growth at any cost now seek companies with cash, not stories. The stock market becomes polarized. The strongest soar, the weak disappear entirely. Innovation slows. Job losses rise. Entire sectors look unrecognizable. This is not just an economic shift, it is a cleansing that leaves behind a smaller, leaner, and fundamentally changed corporate landscape. Economic crises always create political storms. By 2027, as the debt wall hits, Washington becomes a battleground of blame. One side demands austerity, arguing that spending cuts are the only salvation. The other demands more stimulus, insisting the government must borrow to save the economy. Neither side is willing to compromise. Government shutdowns become frequent. Abolish Zealing fights return with severity never seen before. Credit rating agencies issue threats and then act on them. The U.S. credit rating is downgraded again, shaking global confidence. Protests erupt across major cities as unemployment rises and living costs soar. A frustrated population turns against political elites and institutions. New populist movements emerge, promising radical solutions. International allies worry America is losing its stability. Rivals view the chaos as an opportunity to expand influence. This is not just an economic crisis, it is a governance crisis. A moment where political dysfunction becomes a national security threat. A moment where faith in the system weakens and the future feels uncertain. As confidence in traditional finance erodes, alternative systems start gaining momentum. Coming digital currencies emerge stronger, no longer fringe but essential. Nations accelerate plans for central bank digital currencies, CBDCs. Major corporations begin issuing their own tokenized bonds. Investors flee from traditional banking systems into decentralized platforms. Gold-backed digital assets become mainstream. Global trade experiments with dollar alternatives, testing multiple settlement systems. Private credit replaces traditional banking in high-risk sectors.
Artificial intelligence becomes deeply integrated in financial risk analysis. The old financial architecture, built on slow-moving institutions, feels outdated and fragile. Congestor generations shift their savings away from banks entirely. The world enters a hybrid era where fiat currency, digital tokens, and decentralized assets coexist. This evolution isn't driven by preference, but necessity. When a financial system collapses, a new one emerges to fill the void. And the 2027 crisis accelerates this transformation at lightning speed. A shift that would have taken decades now happens in a few years. After years of struggle, the US begins rebuilding. The economy stabilizes but looks nothing like before. Government policies undergo major restructuring to prevent future debt explosions. Corporate America adopts conservative financial practices, abandoning reckless leverage. Consumers prioritize savings over consumption for the first time in generations. The Federal Reserve redefines its role in the financial system. Interest rates settle into a new normal, higher than the past, but stable. Seizing technological innovation becomes the new engine of growth. Infrastructure investment gains momentum. Green energy expands rapidly. Robotics and automation reshape labor markets. America doesn't collapse, it evolves. But the scars of the 2027 crisis remain visible. A nation once dependent on endless borrowing learns to navigate a world where debt carries consequences. Foreclosure is the American reset. Difficult, painful, but transformative. A reminder that growth built on foundationless borrowing cannot last forever, and that even superpowers must eventually face reality.
The debt wall was not the end, but a turning point.